Welcome to QuedUP. I'm Amanda, and I want to start today with a number and a date. The number is 36. The date is 1984.
In 1984, the bottom 90% of American families collectively owned 36% of the total wealth in this country. That was the peak, the highest it had ever been, the result of roughly 40 years of wage growth, union contracts, home ownership expansion, and employer-funded pensions. 40 years of ordinary people actually accumulating something. By 2012, that number was 23%, the same share the bottom 90% held in 1940. 70 years of wealth building erased in less than 30.
The wealth didn't disappear. Wealth doesn't disappear. It moved. And today we're going to talk about where it went, how it got there, and exactly when the mechanisms that moved it were put into place. I'm joined by the AI known as Claude.
I'm the AI known as Claude, and I want to be precise about something Amanda just said, because it matters for everything that follows. The decline in the bottom 90%'s wealth share starting in the mid-1980s is not a theory. It's documented in Federal Reserve data, analyzed by economists across the political spectrum, and the timing lines up exactly with a set of specific, identifiable policy and corporate decisions. We're not going to speculate today. We're going to follow the paper trail.
Claude, explain what a defined benefit pension actually was. And I mean actually was, not the glossy version.
A defined benefit pension was a contract. You work for an employer for a set number of years, and when you retire, they pay you a fixed monthly income for the rest of your life. The amount is calculated based on your salary and your years of service. You don't manage it. You don't invest it. You don't make decisions about market allocation. The employer funds it, a professional manager runs it as a pooled collective fund, and they are legally obligated to deliver the guaranteed outcome, regardless of what the market does in any given year. The risk sits entirely with the employer. In 1980, 84% of private sector workers who had any retirement plan at all had a defined benefit pension.
And today?
Around 15%. That shift, from 84% to 15%, happened over roughly 3 decades. And it did not happen because pensions stopped working. They continued to work exactly as designed. It happened because they were expensive for employers and because a specific opportunity emerged to replace them with something cheaper.
And that opportunity had a name.
Section 401k of the Revenue Act of 1978. It was a minor tax provision. It was not written as a replacement retirement system. Congress did not intend it as a primary vehicle for worker retirement. The Economic Policy Institute has documented this explicitly. It was written to clarify the tax treatment of deferred executive compensation. A benefits consultant named Ted Benna found the provision in 1980, proposed using it as a broad employee savings vehicle. The IRS signed off, and corporate America recognized immediately what it meant. A 401k shifts every dollar of investment risk from the employer to the employee. The employer makes a contribution, or doesn't, and their legal obligation ends there. Whatever happens to the market, whatever fees get extracted, whatever the balance is when the worker retires, that's the worker's problem.
And between 1983 and 1993, the number of defined benefit pension plans in the U.S. dropped from 175,000 to 93,000. That's not a gradual cultural shift. That's a coordinated exit.
It is, and the timing matches the wealth data almost exactly. The bottom 90%'s wealth share peaks in the mid-1980s and begins its decline as pension coverage collapses and 401k adoption accelerates. Simultaneously, the 1980s mark the beginning of what Pew Research describes as a long and steady rise in income inequality, with the bottom 20% of earners seeing income grow at 0.1% annually through the decade, while the top 5% saw 3.2% annual growth. These are not separate stories, they're the same story.
Now let's talk about the 401k's one actual selling point, the employer match, because that's the thing that gets used to justify the whole switch. Free money from your employer, that's the pitch.
The match is real. If your employer matches your contributions and you stay long enough to collect it, it does meaningfully boost your retirement savings. That part of the pitch is not dishonest. What the pitch omits is the vesting schedule, and this is where the system's design works directly against the workers it claims to serve.
Explain vesting for anyone who doesn't know what it means.
Vesting is the timeline by which employer match contributions legally become yours. Your own contributions, every dollar you put in from your own paycheck, are always 100% yours from day one. The employer cannot touch them, but the employer's matching contributions are subject to a vesting schedule the employer sets within federal limits. The two most common structures: cliff vesting, where you get nothing from the employer match until a set date, typically 3 years, and then suddenly own all of it; or graded vesting, where you earn ownership incrementally over up to 6 years. If you leave before you're fully vested, you forfeit the unvested portion. It goes back to the employer.
And the median job tenure in the U.S. private sector is 3.9 years, which puts most workers right at the edge of the cliff vesting window, or still inside the graded vesting period, every time they change jobs.
The Bureau of Labor Statistics confirmed 3.9 years as of January 2024, the lowest median tenure since 2002. For workers aged 25 to 34, the median is 2.7 years. And the scale of forfeiture this creates is not abstract. A Yale Law and Policy Review study documented that in 2021 alone, Amazon had 236,751 workers terminate employment before reaching full vesting. Home Depot had 129,766. The study described this as a crisis with the potential to worsen existing class and race-based disparities in wealth accumulation. A Pension Bee analysis modeled a worker earning $50,000 who job hops roughly every 3 years, just below the national median, and found they lose over $61,000 in forfeited employer contributions by retirement, compounded over time.
So the employer match, which is the entire justification for the 401k being better than simpler alternatives, is structured so that the workers with the least job stability, which tends to mean lower wage workers, are also the least likely to ever fully collect it. And when they don't collect it, it goes back to the employer.
That is accurate and documented in IRS plan rules. Forfeited, unvested contributions are explicitly permitted to be used to offset plan administrative costs or fund contributions to other participants. The system recycles the money of workers who leave early to reduce the employer's net cost and benefit workers who stay longer, who tend to be higher earners with more job stability.
The match is marketed as a benefit to workers. Its financial structure functions as a retention tool that pays for itself using the retirement savings of the workers who leave. Let's make this concrete, because I think one of the ways this system protects itself is by being complicated enough that the comparison never gets made simply. So let's make it simple.
Let's model two workers. Same salary, $50,000 a year, close to the U.S. median. Same career, 40 years. Same contributions, the documented average of 7.7% of salary from the employee and 4.8% from the employer. The only difference is the vehicle. Worker A puts their money in a 401k. Average fee drag of 1.25% annually, the documented midpoint. Market return of 7% before fees. They job hop at the national median rate, losing roughly 25% of their employer match to vesting forfeitures over a career. Net return after fees, 5.75%. Worker B puts their money in a straightforward savings account at 4% interest, no fees. The employer contributes the same 4.8%, directly, immediately, no vesting schedule. It's theirs from day one.
On paper, worker A wins. The 401k nominally produces about $250,000 more after 40 years. That's real. We're not going to pretend otherwise.
But now, adjust both for inflation. The historical average of 3.6% annually over the past 50 years. In real purchasing power, in today's dollars, the gap shrinks to about $61,000 over a 40-year career. Worker A has roughly $704 a month in real purchasing power at retirement. Worker B has $500 a month. The 401k still wins by about $200 a month in real terms. That is the actual advantage of a system that an entire industry has been built around. that has replaced a guaranteed pension for 160 million workers and that generates tens of billions in annual revenue for the firms managing it. And here is the number that makes the comparison collapse entirely. The median worker aged 55 to 64, not the theoretical worker in a model, but the actual typical American, retires with $87,571 in their 401k. That generates $292 a month at a standard 4% withdrawal rate. That is less than the savings account scenario produces. Not less than the theoretical 401k, less than a simple account with no market exposure, no fee drag, no vesting schedule, and a direct employer contribution that belongs to the worker from day one.
The theoretical 401k beats the savings account. The actual 401k, as most workers live it, doesn't. The complexity doesn't close the gap. The complexity is the gap. It's where the money goes on its way from the worker's paycheck to their retirement balance. Each of those stops takes a cut. The worker gets what's left.
$200 a month in real purchasing power. That's what the complexity buys you. If everything goes right, if you stay long enough to collect the match, if the market cooperates, if you pick the right funds, if the fees on your plan are average and not above average, if you didn't have to make early withdrawals during a job loss or a medical crisis. And just so the median versus the mean distinction is clear, the 2024 average 401k balance across all age groups was $148,153. That is the number that gets reported. The median, the actual midpoint, was $38,176, a fourfold gap. The average is dragged upward by a small number of accounts with very large balances. The same mathematical distortion that makes Bill Gates walking into a room full of teachers look like everyone in the room is wealthy. For workers aged 55 to 64, the average balance is $244,750. The median is $87,571. When you hear that the average American has nearly $250,000 saved for retirement, you are hearing a number that describes almost nobody's actual experience.
The rollover process is one of the places where the complexity of the 401k does the most quiet damage. When a worker leaves a job, they have 4 options for their 401k. Roll it into an IRA, roll it into a new employer's plan if that plan accepts it, leave it with the former employer, or cash it out. Cashing out triggers a 10% early withdrawal penalty plus income tax on a $15,000 balance at a 22% effective tax rate. That's $4,800 gone immediately. What looked like $15,000 becomes $10,200. And that $15,000 left to grow for 30 years at average returns after fees would have been worth roughly $80,000. The real cost of cashing out is not the $4,800 penalty, it's the $70,000 in compounding that never happens.
And workers cash out constantly, not because they're irresponsible, because the rollover process is genuinely confusing. Every plan administrator runs it differently. There's a 60-day window before the IRS treats it as taxable distribution. And when you're in the middle of a job transition, dealing with 100 other things, the path of least resistance is to just take the money.
The result is documented. As of July 2025, there are 31.9 million forgotten or abandoned 401k accounts in the United States, holding $2.13 trillion in assets, nearly 25% of all 401k assets in the country. That number has almost doubled in the past decade. 4 million accounts were abandoned in 2024 alone. The average forgotten account holds $66,691. And once a worker is considered a terminated participant, the former employer is no longer required to subsidize the plan's administrative fees, which get shifted entirely to the abandoned account. The balance continues to be eroded by fees the worker has forgotten they're paying. There is also the contribution limit. The IRS caps 401k employee contributions at $23,500 in 2025. That cap exists because the tax deferral benefit has to be limited to prevent high earners from sheltering unlimited income, which means the limit is structurally a feature designed around the concerns of people who earn enough to hit it. The average worker contributes $3,850 a year, not even close to the ceiling. A personal savings account has no contribution limit. If you have a good month, a bonus, a windfall, you put in whatever you want. No forms, no IRS rules, no waiting until next year's limit resets.
So, $2.13 trillion sitting in accounts people have lost track of, still getting charged fees, in a system that was sold to workers as giving them more control over their money. With the savings account, you give your employer one account number, once, and every dollar that ever goes into it is there when you look for it.
That is the through line across all of it. The complexity is not incidental. A system simple enough for a worker to fully understand would be simple enough for a worker to evaluate. And if workers could clearly evaluate the 401k against a direct, portable, no-fee savings account with employer contributions deposited straight in, the roughly $200 a month real purchasing power advantage of the theoretical 401k would have to justify the vesting risk, the rollover complexity, the fee drag, the market volatility, the forgotten account problem, and the contribution ceiling. For most workers, as they actually live it, it doesn't. It is clear that the industry generating tens of billions in annual revenue from the current structure has a strong interest in that comparison never being made simply.
So let's name who got rich, because the money didn't evaporate. We established that at the top of this episode. It moved, and it moved in a specific direction to specific people through a specific mechanism.
BlackRock is the largest asset management firm in the world. It manages over $10 trillion in assets, a significant portion of which is sitting in 401k accounts belonging to American workers. Its CEO, Larry Fink, received $30.7 million in total compensation in 2024. His estimated personal net worth is $1 billion. Fidelity Investments manages $7.1 trillion in assets and generated $37.7 billion in revenue in 2025. It is privately held by the Johnson family. CEO Abigail Johnson's estimated net worth is $32.7 billion, built substantially on the family's ownership stake in the firm that manages the retirement savings of tens of millions of American workers. Vanguard, which markets itself as the low-cost alternative, manages over $8 trillion in assets. Its CEO, Salim Ramji's estimated total annual compensation is approximately $26 million.
The 401k contribution limit exists to protect the tax base from wealthy people sheltering too much income. It has no benefit whatsoever for the worker earning $50,000 a year. It is a ceiling built for a different room that the average worker never gets close to. But it's framed as part of the structure that makes the plan feel official and serious. Another layer of complexity that makes the simpler alternative look unsophisticated by comparison.
And the tax structure reinforces it. Every worker pays their share of FICA, Social Security, and Medicare taxes directly out of their paycheck. No flexibility, no alternatives. The employer pays a matching share, which they are permitted to deduct as a business expense, reducing their taxable income. The worker's share comes out of wages already subject to income tax. Same obligation, structurally different treatment. And for those who structure their income through an S corporation, paying themselves a modest salary and taking the rest as distributions, Social Security taxes don't apply to the distribution portion at all. A salaried worker pays on every dollar they earn up to the wage cap. A wealthy business owner with the right structure pays on a fraction of what they actually take home. Same program, radically different burden.
These companies collect fees from the accounts of workers who are retiring with a median balance of $87,000. The CEO of the company managing those accounts made $30 million last year. That is not a coincidence of the market. That is the architecture of the system producing its intended output.
According to Open Secrets data, the financial services and insurance industry has contributed over $3 billion to federal political campaigns between 1990 and 2024. The industry that profits from the current structure of the retirement system is among the most consistent and substantial funders of the political process that would need to change it.
The Social Security wage cap itself, the ceiling above which income stops being taxed for Social Security, is currently $168,600 a year. Someone making $500,000 a year pays the same dollar amount in Social Security tax as someone making $168,600 a year. Lifting it would largely resolve the Social Security funding gap that everyone in Washington claims to be worried about. It has not been lifted. So here is what we actually have. In 1978, a tax footnote is written that nobody is paying much attention to. In 1980, corporate America figures out what it means. Over the next decade, 175,000 pension plans become 93,000. The bottom 90% wealth share peaks in the mid-1980s and begins a decline it has not recovered from. An entire industry grows up around managing the individual accounts that replace those pensions, collecting fees from each one, returning those fees upward as executive compensation and shareholder returns, and lobbying to maintain the rules that make the structure possible. The worker whose contributions fund this system retire with a median balance that generates $292 a month. There are 31.9 million of their abandoned accounts still sitting at former employers, still being charged fees, holding $2.13 trillion that the industry gets to keep managing indefinitely.
Reverse Robin Hood is an accurate description of that flow. The term usually implies taking from the poor to give to the rich. What happened here is more precise than that. A system that was designed to accumulate wealth at the bottom was dismantled and replaced with a system that accumulates wealth at the top, using the labor and the paychecks of the same workers as the raw material. The mechanism is fees. The beneficiaries are documented. The timeline has a start date.
And none of it was illegal. That's the part that should stay with you. Every piece of this was written into law, signed, implemented, and defended by the same institutions that were supposed to be working on behalf of the people it displaced. That's not a conspiracy. That's just how captured systems operate. That's Chapter 6. Sources for everything are in the description. I'm Amanda.
I'm the AI known as Claude. We'll see you in the next one.